This put credit spread strategy has been a killer over the past year and a half or so. We're going to go over the trade setup here in a second, but let's go through the stats first. We've got a 72% win rate, which may not seem that impressive at first, but when you consider the fact that we're selling at the money put spreads that in theory should only win 50% of the time, the fact that this has won over 70% of the time is exactly why we're talking about this and why this made so much money in an account of this size. Now, one of the most important aspects I'd like to point out here is the actual risk reward of the trade. Now, most educational resources on credit spreads are going to steer you in the direction of selling high probability, far out of the money options for small credits, but a really high win rate. Now, you probably already know this, but eventually that type of strategy will end in ruin, as one loser can easily wipe out most of your gains from a lot of your winners. But by selling at the money options, you can get out of the trap of giving back all your gains and having to start over, but you need an edge on when the best days to sell put credit spreads in this manner. Now, we'll get to the edge here in a second for this strategy, but let's talk about the risk reward. Your risk reward here is better than a 3-2, with the average loss being just shy of $300 and the average gain being just over $200. And this is just trading one spread at a time. Now, for this put credit spread strategy, we're looking to open a trade towards the end of each day that expires in a week or 7 days later, so long as two technical conditions are met. If either one of these conditions are not met, we simply skip the trade for that day. As you can see in the P&L curve here, there are periods of flat lines, which means that no trades were taken during those periods because the technical conditions weren't met. Now, since selling at the money put credit spreads is a bullish strategy, we only want to open these trades if the probability of the market closing higher in the next week is high. So before the trading week begins, the first thing we are going to check is the weekly triumph rate from alphacrunching.com. Now, the weekly triumph rate, also known as the WTR, is just one of the features alphacrunching.com has that helps retail traders find an edge in the market. Now, I'm already logged in to alphacrunching.com, and I'm going to navigate over to the triumph rate and click on the WTR data button. And one of the cool things about the WTR, as well as all the tools here at Alpha Crunching, is all this data comes out before the trading week begins. So before Monday's open, you already know which days of the week are possible candidates for opening a put credit spread trade. This is really going to cut down on the amount of time you need to spend for this strategy. So what is the WTR? The WTR stands for weekly triumph rate, which shows the historical percentage of times SPX has closed higher 7 days later over the last couple months. Another way to say that is it's the rate at which the market closes higher for each day of the week. For example, Monday's WTR for the upcoming week is 71%. This means that over the past 2 months, Monday has closed higher 7 days later, 71% of the time. So it has been mostly higher the following week. Tuesday has closed higher only 56% of the time, and so on. And as you can imagine, in bullish markets, the WTR is going to be higher and increasing. And when the market is pulling back or in, let's say, a correction mode, the WTR is likely going to be decreasing and lower. So before the trading week begins, we're going to look at the WTR for each day, and we're going to look for days that have a WTR value of 50% or higher. That's our first technical criteria that needs to be met in order for us to trade these at the money put credit spreads. The second criteria is a simple moving average setup. So I'm going to hop over to TradingView, where I'm on the SPX daily chart, and I have two simple moving averages. I have the 5-day simple moving average and the 10-day simple moving average. The 5 is yellow and the 10 is blue. And what we're basically looking for is some confirmation that the market isn't falling off a cliff at some point. Because remember, we're looking at the WTR before the trading week begins, and then something could happen and a downtrend could start, and we want to confirm that the market is still in an uptrend. And one of the easiest ways to do that is look at the position of the two moving averages. When the market is in an uptrend, the shorter one in yellow, the 5, will be above the 10. And that's telling you that in general, the market is in an uptrend. And when the market is pulling back, that shorter moving average is going to lead the way down until the short trend is over. And then the 5-day moving average will lead it back up as well. So once the trading week begins, what we're going to be looking for is the days that the WTR are 50% or greater. And about 30 minutes before the close, we're going to check this moving average position. About 30 minutes before the close, if the 5-day moving average is above the 10-day moving average, then we would put on that at the money put credit spread because both of the conditions are met. Remember, the WTR needs to be 50% or higher, and the 5-day moving average needs to be above the 10-day moving average. This simple yet powerful combination of the Alpha Crunching WTR with that simple moving average setup is a simple go, no-go system that only takes a few minutes per day to execute. Now, I'm going to write out the rules of this strategy in the description of this video below for easy reference for later, but be sure to like this video if you want to refer back to it later so you can review the setup. And if you have any questions, let me know in the comments, and I'll see you in the next video.